The coupon for the programs on building your wealth has the largest price increase ever coming May 16th. So make sure you use the coupon code Back to the Moon link down below before that date. Hey everyone, me Kevin here. Let's talk about the Fed. First of all, could Jerome Powell get more hawkish? Then we're going to talk about what's priced in, what the Fed has said so far, fourth, what the Fed is likely to say tomorrow, and let's go. And of course, if any of this stresses you out, get yourself life insurance in as little as 5 minutes just by going to metkevin.com/life. It's that simple. metkevin.com/life, Apple Pay, Android Pay, boom, get life insurance. It's the same one that Lauren and I have. We've been Apple paying ever since the pandemic. All right, here we go. Will Jerome Powell get more hawkish? Well, expectations are yes. He's probably going to get more hawkish now than later. In fact, we kind of expect that now there's a real opportunity that Jerome Powell could go dark on us, too much so that he, who used to be a dove, could end up becoming the hawk that says, no, we're going to stay ahead and get ahead of inflation, which they're nowhere near ahead of inflation right now, which will give rise to a lot of fear and uncertainty regarding potentially being Volckered. Now, I don't actually think Jay Powell's going to Volcker us. Volckering would be like raising rates up to like 4 to 8% to try to actually fight inflation. Right now, we're not even at neutral, right? Neutral is 2 to 2.5%. We're at literally 0.25% right now. We're going to go up to like 0.75. Big freaking deal. But his tone could end up being hawkish tomorrow, though I hope that it's potentially the worst likelihood of him being hawkish compared to future meetings. And the rest of my explanation will explain why. So let's talk about what's priced in. Well, right now, a 50 basis point hike, a half percent hike is priced in for May. That meeting is tomorrow, May 4th. I will be live streaming that meeting as usual. Now, I do expect to be live streaming that meeting at a different channel, at Meet Kevin Live. That's right. I might be moving all of my live streams to a different channel and then posting sort of some updates to this channel, or sort of more put together videos on this channel, or clips from those lives on the appropriate other channels I have. So one of the first links that you're going to see down below is actually the link to that other channel. Don't feel weird about the fact that there are no videos or thumbnails or anything. Yeah, it's because we're just going to go live with the Fed meeting probably tomorrow. So stay tuned for that. Do check that out, link down below. We will be live streaming at 11 a.m. Pacific time for the Fed meeting. We might do market open on that channel. And we will also be live streaming at 11:30 when Jerome Powell, and he's usually very punctual, goes live to answer questions. That Q&A is going to be very, very critical. So 50 basis point for May 4th tomorrow. May the 4th be with us. Has 100% certainty based on market expectations. And remember, the Federal Reserve generally likes to do roughly what the market is expecting. Now, that doesn't mean that the Fed won't bleed us out like they kind of have been the last 4 months. They will do that to reduce the wealth effect and kind of try to constrain lending and spending, which is a part of kind of like restricting an economy, right? So the stock market has sort of been a byproduct of the Federal Reserve's actions. This is pretty obvious and clear. But they don't want to shock us to the point where they freeze lending or institutions from functioning, because that's how you get things like the 2008 recession. So the meeting thereafter is the June 14th to 15th meeting, and we'll get a new summary of economic projections in that meeting as well. We will not have a new SEP, Summary of Economic Projections, during the May 4th meeting. That's actually kind of good, because in March, the last time we got the SEP, we kind of had this like sudden collapse and heart attack in the stock market when the Fed's GDP estimate came in at 2.9%, which was under the 3.5% we expected, since we've had this negative, especially since we've had this negative Q1 of GDP. So like if we get an SEP in June, we're probably going to look and go, oh my gosh, like growth is maybe only 1.5% projected by the Fed, right? That would be kind of a two-folded problem. One, it's like, oh my gosh, there is a real risk that the Fed drives us into a recession and that we don't have a soft landing. And so that SEP is going to be quite interesting. But again, we won't get that in May, so no SEP. Next economic projections will be in June. However, what we will get will probably be some form of insights into the Federal Reserve's path about continuing either doing 50 basis point hikes or going with 25 basis point hikes hereafter. At this point, again, markets are expecting a 100% chance at a 50 basis point hike tomorrow. And then now there's a range for June. There's a 4 to 40% chance, depending on what sort of expectation measure you're looking at, of a 75 basis point hike in June. That pretty much means another second 50 basis point hike is already priced in for June. And then we'll be at 75 as sort of like the upside risk for June. on top of getting an SEP in June. So, but, again, hopefully, some CPI numbers start coming in soft and we actually get a softer Fed in June. So we'll see as the data comes in. But let's stick to a little bit more of what we know. So we know that the Fed is, and they've given us this in their last minutes, that they're expecting to start phasing off the balance sheet by running off about $35 billion first. $20 trillion of treasuries, 15 of MBS, mortgage-backed securities, and then eventually increase this to $60 billion of U.S. Treasury and $35 billion of mortgage-backed securities in about 3 months. Now, we'll talk a little bit more about how I think the balance sheet is going to sort of be impacting markets here, but it's important really to see that if markets right now are pricing in 50, or 75, and then 25 basically for the rest of the year. They're doing that because the Federal Reserve and JP have told us we will be at 2.5% by the end of the year. Now, getting to 2.5% by the end of the year can be done in an equal path, like in 2004, which Jerome Powell first said it's going to be like 04, 17, 25 basis point hikes. Or it could be kind of like 1994, where they have larger hikes up front, and then they kind of taper and have smaller hikes towards the end of the year. Right now, the Fed is telling us that's exactly what they plan to do. 50 would get us, and then 25 basis point hikes the rest of the year would get us to exactly 2.5%. So that's pretty much the generic expectation. Now, it's possible that if they do 75, that they end up doing a 0 hike at the end of the year, which could end up being like one of those really positive U-turns that we like looking for. We like the Fed going from hawkish to dovish. That's really good for markets. When the Fed goes more hawkish, it's usually really bad for markets. So, again, initially, the Fed said they're going to go 25 steady Eddie. Now they're saying, never mind, we're going to front end it. We're going to go 50, maybe 50 or 75, and then go 25s. But, the Fed not only flip-flopped on that, but there's also the potential that we're going to get some insights on their flip-flop regarding the war. See, initially, in February, at the congressional testimony, Jerome Powell told us that the Fed thought war was a game changer, that war would slow spending and potentially, even though it would bring up inflation for food and energy in the short term, might actually bring down spending because people are fearful that now we have a war going on. However, the exact opposite is happening, a sign that could actually reiterate Jerome Powell becoming more hawkish, which is not so good. And so if you're kind of catching my drift so far, Jerome Powell's probably going to be a little bit more on the hawkish side tomorrow, and even though I'm really optimistic we're going to get some green like we did in March, I don't know. I'm less certain than I was in March. Like in March, I was like, 80%, like we're going green if we get 25 BP. Now I'm probably more like 50-50. And the reason for that is the Fed flipped twice on us, first saying 2004, now going 1994, and then saying war is a game changer, but wait, it's not. Which that's what earnings reports are telling us. So in fairness, they're kind of just adjusting to what the market is doing, but it's still flip-flop. So now, data. What about the data? Well, inflation expectations are steady. However, they're likely steady in one part, the part of consumers, and in the second part, the part of markets, both things we can measure by consumer sentiment surveys, and of course the 5-year break-evens and bond break-evens. We can measure inflation expectations. Those are steady and down, in part because the Fed is talking really harsh talk, but also because they're expected to walk the walk. So for those of us who are wondering, like, Kevin, isn't there a chance that the Fed goes for a 25 basis point hike tomorrow? Highly doubt it. Highly doubt it. The market is pricing in 50 BP. The Fed now needs to walk the walk. They need to put their big boy pants on and raise the freaking rates already. We're still accommodating markets. Remember, as long as we're under 2%, we're still accommodating markets. We're still stimulating. Why are we still stimulating? But this is originally why also in January I thought that the Fed was just going to hike us to 2% in one meeting. Like, okay, that would have been aggressive. Yeah, that would have created a real shock to the heart and the markets. But anyway, tomorrow we're likely to hear that the Federal Reserve is vindicated in raising rates, and they're going to give us the following facts. Again, they're going to tell us that we're still accommodating markets. We got to get to neutral. Number two, it's going to take probably 18 months for the Federal Reserve's balance sheet reduction to actually hit the markets. That's because we've got like $1.6 trillion of excess liquidity lying around in the reverse repo market with banks, which basically means even though they're running off the balance sheet, there's still a lot of money slushing around in the system, especially at banks. Number 3, jobs data is on fire with jobs opening reports coming in hotter than expected. 11.5 million job openings versus 11.2 expected. Again, is going to vindicate the Fed going, let's go 50, and lead to some hawkish talk from the Fed. Earnings are coming in way stronger than expected, which means more of a hawkish tilt from Jerome Powell because, oh no, war's actually not slowing down spending. If anything, people are spending more in travel. I mean, look at Airbnb's beat today. The advertising sectors are beating. The airline sectors are beating. The restaurant sectors are beating. And people are still spending money on consumer goods. A little less so online goods and a little less so durables, but they're still spending. And less on used cars. Number 5, the Fed is also likely to brush off the Q1 negative GDP print. Some folks think this is going to lead Jerome Powell to go dovish. I don't think so, because the Q1 GDP negative print was created in part because of Omicron. I remember January. In fact, I put it on my Instagram story. I'm like, what the hell? Is this like a recession or what's going on? Like, because I went to restaurants and I'm like, there's nobody there. Everybody's just homesick with Omicron. And also in part caused by supply chain issues, since GDP did not miss on the consumer end. It actually did very well on the consumer end, but it instead missed due to a widening trade deficit and lack of inventory rebuilding due to supply chain issues. So in other words, people still spending, but we're not actually able to spend on certain things like inventory or as much trade because we have too many supply issues in other parts of the world. In other words, another reason why Jay Powell's likely to go a little bit more hawkish tomorrow. Number 6, it's also likely that Jerome Powell, even though forecasted inflation expectations are we're going to have a weak inflation report in May for April with just a 0.2% month-over-month gain or 0.4% core, which implies a drop in energy and food prices from March, a peak. The data will still likely reiterate Jerome Powell being a hawk for now because A, we're not getting the data for another week after the Federal Reserve meeting, and Jerome Powell has told us we're going to act first and wait for the new data second. So they're being pretty damn clear with us that we're probably going to expect hawk Powell tomorrow. However, I think we might end up seeing the last of not the Mohican, but of harsh Powell. If we get positive data by May 11th and before the June 15th meeting when we get the May CPI data, it could mean that we could end up getting a little bit of a dovish Fed in June. But I don't see a lot of reasons for the Fed to be dovish tomorrow. Now, even though I'm optimistic that Jerome Powell will see some reasons for hope, he told us he's not going to act on hope. So I'm actually less optimistic for green after Powell tomorrow. But I will tell you, most people, whether it's good news or bad news, just don't invest in the stock market before catalyst events. So if there's any good news, and in my opinion, a reason for the market to actually run off these lows is because once catalyst events occur, like the FOMC meeting, guess what usually happens? We usually end up going, all right, well, we got the news. All right, we had a little bit of a hawky Powell. All right, let's go back into the stock market. Like it's just very common. So like I'm long the market. I'm optimistic that we're essentially near a bottom, but I'm not expecting Powell to be very nice tomorrow. I expect that more so in June and certainly towards the end of the year. So do keep in mind as well that if you're trading during the Fed meetings, stocks usually drop. Okay. Anyway, thanks so much for watching. If you like my perspectives, learn everything that I know about investing in real estate, stocks, property management, making YouTube videos, and being a real estate agent via the programs linked down below on Building Your Wealth and that expiring coupon code May 16th. Thanks so much. Bye.